Consignment is a business arrangement where goods are sent by one party to another for the purpose of selling. This arrangement is beneficial for both parties involved. One party, the consignor, sends goods to another party, the consignee. The consignee then takes on the responsibility of selling these goods to the end customers. The consignee sells the goods on behalf of the consignor, acting as an intermediary in the transaction process. The consignor retains ownership of the goods until they are sold, meaning the risk of unsold inventory remains with the consignor. The consignee receives a commission for selling the goods, which serves as their incentive to maximize sales. Losses in consignment refer to a decrease in the value of consigned goods. These losses can significantly impact the financial health of a business. This can happen due to various reasons. These reasons include damage during transportation or storage, theft, which is a common issue in retail environments, or obsolescence, where products become outdated and lose their market value. Understanding how to account for these losses is crucial for accurate financial reporting. Proper accounting practices help in reflecting the true financial position of the business. Proper accounting for consignment losses ensures transparency in financial statements, which is essential for stakeholders. It also helps businesses make informed decisions regarding inventory management and future consignments. This essay provides a step-by-step guide to accounting for both normal and abnormal losses in consignment, ensuring that businesses can maintain accurate records and make strategic decisions. In consignment accounting, it's important to differentiate between normal and abnormal losses. Normal losses are inherent to the nature of the goods or the consignment process. They are expected to occur due to factors like evaporation, spoilage, or normal wear and tear during transit or storage. Abnormal losses, on the other hand, are unexpected and arise from unforeseen circumstances. These include losses due to accidents, theft, fire, or gross negligence. Differentiating between these losses is crucial, as they are treated differently in accounting. Understanding the distinction between normal and abnormal losses is crucial for accurate accounting. It ensures that losses are recorded appropriately, and financial statements reflect the true financial position of the business. Normal losses are an anticipated part of the consignment process. These losses occur naturally due to factors such as spoilage, evaporation, or minor damages during transportation and handling. Understanding how to account for these losses is crucial for maintaining accurate financial records and ensuring that the true cost of goods sold is reflected in your financial statements. Here's a step-by-step guide to account for them. By following these steps, you can ensure that your business remains compliant with accounting standards and that your financial health is accurately represented. 1. Determine the normal loss rate. This is usually based on industry standards, historical data, or the nature of the goods. For instance, perishable items like fruits may have a higher normal loss rate compared to durable goods like electronics. Analyzing past data and industry benchmarks can help you establish a realistic normal loss rate. 2. Calculate the value of normal loss. Multiply the total value of consigned goods by the normal loss rate. For example, if you have consigned goods worth $10,000 and the normal loss rate is 5%, the value of normal loss would be $500. This calculation helps in quantifying the expected loss in monetary terms. 3. Adjust the value of consigned inventory. Reduce the value of consigned inventory by the calculated value of normal loss. This adjustment ensures that your inventory records reflect the actual value of goods available for sale, excluding the anticipated losses. And 4. Recognize the normal loss. Debit the cost of goods sold account and credit the consignment in account for the value of normal loss. This accounting entry ensures that the cost associated with the normal loss is appropriately recorded in your financial statements. By following these steps, businesses can accurately account for normal losses in consignment, ensuring that their financial statements reflect the true cost of goods sold. Properly accounting for normal losses not only helps in maintaining accurate financial records, but also aids in better inventory management and financial planning. Let's assume Company A consigns 1,000 units of a product to Company B, with each unit costing $10. The agreed normal loss rate is 2%. First, the normal loss quantity is 1,000 units times 2%, which equals 20 units. Second, the value of normal loss is 20 units times $10 per unit, which equals $200. And third, the adjusted value of consigned inventory is $9,800. This example demonstrates how to calculate and account for normal losses, ensuring that the value of consigned inventory is appropriately adjusted. Section 5. Accounting for abnormal losses, a step-by-step guide. Unlike normal losses, which are anticipated and accounted for in the regular course of business, abnormal losses are unexpected and require a different accounting treatment. These losses can arise from unforeseen events such as natural disasters, accidents, or even human error. Properly accounting for these losses is crucial for maintaining accurate financial records and ensuring the financial health of the business. First, determine the quantity and value of abnormal loss. This involves a detailed assessment of the inventory to identify the damaged or lost goods. Accurate measurement is essential to ensure that the financial impact is correctly recorded. Identify the specific event causing the loss and quantify the affected goods and their value. Next, investigate the cause. This step is critical as it helps in understanding whether the loss was due to negligence, an unavoidable accident, or other factors. Knowing the cause can help in preventing similar losses in the future. Conduct a thorough investigation to determine the reason behind the abnormal loss. Then assign responsibility. This might involve interviewing staff, reviewing security footage, or consulting with experts. The goal is to get a clear picture of what happened and why. If the loss is due to negligence or fault of either the consignor or consignee, the responsible party bears the cost. This ensures that the financial burden is placed on the party at fault, rather than the business as a whole. Legal or contractual agreements may come into play here, and it might be necessary to involve legal counsel to resolve disputes. Finally, record the abnormal loss. This step involves making the appropriate journal entries in the accounting records to reflect the loss. Proper documentation is key to maintaining transparency and accuracy in financial reporting. Debit the loss on consignment account and credit the consignment in account for the value of abnormal loss. This ensures that the loss is accurately reflected in the financial statements, providing a true picture of the business's financial position. Accurately accounting for abnormal losses allows businesses to identify the root causes and take corrective actions to prevent similar losses in the future. By understanding and addressing these issues, businesses can improve their operations, reduce the risk of future losses, and enhance overall financial stability. Section 6. Illustrative example, accounting for abnormal consignment losses. Suppose, in the previous example, a fire in Company B's warehouse damaged 50 units of the consigned goods. 1. Value of abnormal loss, 50 units times $10 per unit equals $500. 2. Investigation. If the fire was due to faulty wiring in Company B's warehouse, they would bear the loss. This example illustrates the steps involved in accounting for abnormal losses, highlighting the importance of investigation and responsibility determination. Section 7. Journal entries for consignment losses, a clear overview. Here are the journal entries for recording both normal and abnormal consignment losses. Normal loss, account, cost of goods sold, debit, XX, credit consignment in, XXX. To record normal loss on consignment. Abnormal loss, account loss on consignment, debit, XXX, credit consignment in, XXX. To record abnormal loss on consignment. These journal entries ensure that the losses are appropriately reflected in the financial statements, allowing for accurate profit calculation and inventory valuation. Section 8. Importance of accurate loss accounting in consignment. Accurate accounting for consignment losses is crucial for several reasons. First, accurate financial reporting. Proper accounting ensures that the income statement and balance sheet accurately reflect the actual cost of goods sold and the value of inventory on consignment. Second, informed decision-making. By understanding the reasons behind losses, businesses can make informed decisions about pricing, inventory management, and choosing reliable consignees. Third, fraud prevention. Maintaining a clear record of consignment transactions and losses helps deter fraudulent activities and ensures accountability. By prioritizing accurate loss accounting, businesses can maintain transparency, make better decisions, and safeguard their financial health. Section 9. Conclusion. Mastering consignment losses for business success. Mastering the accounting treatment for consignment losses is essential for businesses engaged in consignment arrangements. By understanding the difference between normal and abnormal losses, following the step-by-step accounting procedures, and implementing robust internal controls, Businesses can ensure accurate financial reporting, minimize losses, and make informed decisions to drive profitability and growth.